There's a real chance you're on track to hand the IRS tens of thousands of dollars you're never going to get back. And it's probably not your fault. No one ever sat you down and walked you through the one move that could have stopped it. We've spent decades across the table from families in exactly your spot. So here's the part that should get your attention. That move, a Roth IRA conversion, done right, is one of the best tax moves we think you'll ever make. Done wrong, it could be one of the most expensive. Same decision, opposite outcome. And almost no one tells you which side of that line you're standing on.
We'll show you exactly when a conversion is a weapon, including the one window most people don't even realize they're standing in, where the tax savings for the right family can run into 5 figures a year.
One thing to know up front, right now, we think tax rates are historically low. They are historically low. We happen to think the tax rates are on sale. The government's running record debt, record deficits, and at some point, the bill's going to come due. We're not predicting a date, and nobody should ever act on a law that doesn't exist. But the rates in front of you today are low by most historical measures. And that matters for everything that we're going to talk about today.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. So a quick version of what a conversion even is. You take money out of your traditional IRA or 401k, you pay the taxes on it now, and you move it into a Roth IRA where it grows tax-free for the rest of your life and for 10 years after that for whoever inherits it. That's it. And here's the reframe that should change how you think about this. A Roth conversion is not an investment decision, it's a tax decision. The real question was never, should I convert? It's how long do I keep kicking the tax can down the road? Because in a traditional IRA, the longer you kick that can, the heavier it gets.
Now, here's the part almost no advisor brings up, and it's the most important thing in this whole video. If you're married, every single year you're married is a low tax year. Not because your income is low, but because the day one of you is gone, the survivor stops filing jointly and starts filing as a single taxpayer. And when that happens, the brackets don't shrink a little, they get cut in half. Same income, nearly double the tax.
So we'll make this real because it happened in our own family. Our dad did this kind of planning for decades, always thinking 10, 15 years out. He passed in 2019. The very next year, our mom's tax bill was almost double what it had been on roughly the same income. It wasn't a mistake. That's just how the code treats a single filer. The difference is our dad planned for it. Had he not, that number would have been far worse. That's the trap a conversion is built to diffuse. You move money into a Roth now while you're married, while rates are low, so the survivor isn't handed a tax bill on top of everything else they're already dealing with.
In just a minute, we'll show you the one move that decides whether a conversion saves you money or quietly backfires, the part almost everyone gets wrong.
If this is the kind of thing you want more of, the quiet planning that happens behind the scenes, not the flashy market predictions, that's exactly what this channel is. Subscribe and it'll find you. So here's where people start getting into trouble and where the smart ones pull ahead.
Now, you might be thinking, if this really is such a smart move, my CPA would have brought it up by now.
Yeah, we figured you might feel this way. So let us tell you about a CPA we sat across from a while back. Person was decades in the business. It's actually his final tax season before retiring. Corner office, the whole thing. We had clients converting to Roth, and he stopped us and asked, why would we do that? We told him, first, we think tax rates are headed higher. Second, what happens when one of them is gone and the survivor is a single taxpayer sitting on a giant required distribution every single year?
Not to mention all the interest and dividends and capital gains that were going to be the same the next year anyway.
And he said, I never thought of that. Interesting. Decades of experience, and it wasn't on his radar. This is not about your CPA being bad at their job. It's that almost nobody is looking 10 and 15 years down the road for you.
And the other thing you might be thinking, this is one of those moves that only works if you've got $10 million.
I disagree with that.
I do too. I mean, I think it kind of works for everybody, regardless of wealth. But I think the thing to keep in mind is that everybody's tax situation is different. So what's right for you may not be right for your sister or your neighbor or your best friend. It's like a snowflake. Every tax situation is unique.
So we'll be straight with you, though. This isn't magic, and it doesn't apply for exactly everyone. If most of your savings is already in Roth accounts, a conversion does very little for you, and chasing it is a waste of your time. Especially if you're going to need that money in the next couple of years, it can be the wrong move entirely. But if the bulk of your retirement is sitting in a traditional IRA or 401k, the gap is real, and it's costing you something every year you wait.
Here's one most people never think to use when the market drops, and it always seems to in a given year at some point at least. Most people just sit there and worry. So what do you think?
So a down market is actually one of the best times to convert. The same shares, the same fund, they're worth less on paper that day. So you pay a tax on a smaller number. And when the market eventually recovers, all of that recovery happens inside the Roth, completely tax-free. So a scary day in the market can quietly become one of the better tax moves you can make all year. The drop isn't your cue to panic, it's your cue to convert.
Okay, so where does this go wrong? Because again, the biggest mistake might be converting too much in a single year.
Yeah, when you convert, that money counts as income that year. And if you convert a huge chunk all at once, it can push yourself into a higher tax bracket, paying a higher rate than you ever needed to. And here's the part that catches people, the one we promised you. There's a Medicare surcharge called IRMA.
IRMAA.
Yeah. So if your income crosses certain lines in a single year, you pay more, sometimes a lot more, for the exact same Medicare coverage. And it's sneaky because it's based on your income from 2 years earlier. So you convert this year, and the bill quietly shows up 2 years later, long after you've forgotten about it.
And some people don't even know it's there. So from our standpoint, we don't just look at the tax, we look at the total cost. If your conversion is going to cost you $22,000 of tax, but it also triggers, say, an extra $100 a month in Medicare, then it's not a $22,000 decision anymore. When we evaluated the $22,000 plus the IRMA surcharge. If it's a married couple, $100 per couple, 12 months a year, it's an additional $2,400. So you're kind of in the 24.2% bracket. And so we call it the full number and try to plan around it.
One more. If you can, don't pay the conversion tax out of the IRA itself. Say you convert $100,000 and you owe the tax. If you pull that money straight out of the account, then less ends up growing tax-free. When you can, cover the tax from outside savings instead. Every dollar you converted gets to keep working for you. We understand not everyone can do that, but if you can, it really matters.
What's the move that decides, whether this works? Almost never one giant conversion. It's partial conversions done on purpose year after year.
You fill up a tax bracket, and then you stop. Convert just enough to get the benefit without tipping into the next bracket or, worse yet, tripping that Medicare surcharge. Then you do it again the next year, a little at a time. The right amount for your situation in the years that actually make sense for you. The successful conversions we've seen almost always happen one bracket at a time.
Which is why the real question was never, should I convert? The real question is, how much this year for my situation? Because what your neighbor did, your brother-in-law did with theirs, that has nothing to do with your answer. You measure a Roth conversion in decades for your lifetime, not months or years. So now you know how to stop overpaying while you're alive, and you're building something most people never do, a pool of money the IRS can never tax again. But here's what almost nobody ever tells you about that money. It isn't just a tax win. It might be the one thing that keeps you from running out of money entirely. Because here's what should stop you cold. You could retire with the exact same savings as your neighbor, earn the exact same average rate of return over the exact same years, and still watch them build wealth while you run out of money. Same portfolio, opposite ending. And the reason isn't luck and it isn't the market. It's one risk almost no one has warned you about until they're already living it. Here's a video that shows you exactly what that risk is and what prepared families do in the years before retirement, so they're not the ones who run out of money. Watch it now so you're not the one who finds out the hard way. Because investing is the easy part.